The Philippine Stock Exchange Index hovers among two-week highs and the highest in more than 6 months since PBBM revealed anomalous flood control projects in his State of the Nation address. So where to next for the index this year? Our next guest predicts a possible breakout off of the 6,500 level. Well, with us now for more is Rastine Mercado, Research Director at China Bank Securities. Good to have you back on, Ras. Welcome to the program.
Hi, good morning, Kathy. Thanks for having me.
So what are the key drivers of your forecast?
Okay, so what has been interesting over the past couple of weeks, or at least more evidently over the past week, is we've actually been holding above 6.4 or 6.350 to 6.4. That's coming despite the weakness you're seeing in U.S. markets, right? So typically, when there is weakness in U.S. markets, we follow suit. Certainly, there are concerns over, of course, the sustainability of the rally from earlier this year, especially given that we continue to have that backdrop of soft economic growth. So that's interesting to see. We've been seeing foreign fund inflows as well, and hopefully that's what leads us higher. If we see better participation from foreign funds, I think they're looking at more value stocks across the global markets, and we certainly fit that bill.
Big caveat there, the foreign fund flows that we're seeing. How sustainable is that, and what do you think is going to drive them forward?
Okay, so I think one thing in the US, you do have those concerns over AI, right, and tech. So I think that's entering a healthy consolidation or correction phase after running up for so long, right? So heading into this year, I think the context that's important is we are one of the cheapest in terms of PE in the Southeast Asian region, right? So certainly, if you're a fund heading off of last year, coming off of I have a lot of exposure in an expensive market. Maybe I'll shift some of that away into a cheaper market, and the Philippines being one of that. I think we were close to 10 times at the end of last year. Maybe that's where we can move some of this of our profit, right? So I think that's what's been making foreign funds come here. We are still seeing them come in trickles. I think north of 100, 200 million a day over the past 1-2 weeks. And I think the outlook for growth or GDP to pick up this year certainly helps underpin those flows.
Exactly to your point. I mean, growth isn't really there. Growth is slowing, but then, money is going to look for the cheaper markets at this point. There is this sort of decoupling that's going on. I mean, the sustained recovery on the PSEi is happening as the Nasdaq last Thursday suffered its worst 3-day rout since April's meltdown. So how do you think that sell-off in the U.S. is not spooking investors here as much or at all?
Yeah, so interestingly you brought it up. If you look at historical data, when U.S. markets steeply sell off, we typically follow suit. Although it's not the same when the U.S. is heading into new highs, we don't typically follow that, right? So I think what's key for U.S. markets is that even if the ongoing sell-off is there, it remains orderly. It's not as steep, and I think that's conducive to investor sentiment remaining supportive of rotation into other markets, right? But I think specific to what's been happening over the past few weeks, I think again we're cheap, and if you're looking at it from a numbers standpoint, we did see growth kind of slow in the second half of last year, right? So just looking at if we ramp up infrastructure spending this year, from a number standpoint, that sets you up for a pretty low base from last year. So you're going to see higher growth in the second half of this year, right? So I think just looking at that and the sustainability of that trajectory into 2027 is certainly something that investors should be optimistic about.
There's still a lot of ifs there, Raz, but is there a potential to decouple from the U.S. markets in terms of the equity market moves here?
Hopefully, in the near term, we do. There's certainly room for us to move higher and for them to correct. So I guess we could be seeing that, especially if the fund flows continue to flow into our market. So here's to hoping that continues through.
Well, investors here are still saddled by the government catch-up plans, taking a couple of quarters before that recovery is felt. What impact do you think that might have on risk appetites as the waiting continues before that catch-up plan kicks in?
Well, I think certainly markets are forward-looking, right? So I think what we're seeing now in terms of price action is already in terms of mindset there, right? That we will be accelerating spending, government spending this year. But I think investors will stay reactive to how disbursements come along over the next couple of months, how the pace at which we're getting there. So I think certainly room to move up just because the expectation is there. But then investors will stay reactive to upcoming progress reports that will come out.
Well, if we were to describe where you stand now in the equities as an asset class, what would that be? Would it be cautiously optimistic, prudent?
I think we've been cautiously optimistic for a while. Our key messaging right now is we're actually priced for caution, and we're now open to recovery. I think right now we've kind of put down our expectations in terms of earnings growth, in terms of valuations, and that in itself already speaks that investors here might have already been coming off of multi-year. There's some sort of I wouldn't say anxiety. I think it's more of a series of years where you expected the PSEi to move up by this much, but then only to fall short of those expectations, right? So I think that given that expectations are now subdued, there is room for us to kind of surprise to the upside. And I think that equities will remain favorable asset class. Again, if you're expecting GDP growth of north of 5%, inflation of around 3%, so earnings growth should at least be in the high single digits, right? So if you're comparing dividend yields as well, some of those dividend yields are more attractive compared to the risk-free rate at this point, or the benchmark rate. So I guess that should help underpin interest in equities over the long term. And I guess certainly right now, if you're looking for yields, if you buy at cheap levels, then earnings growth continues. Those dividends should, thinking about it, just come up for so long as the payout ratio stays the same, right? So
Final point,
I think it's
a lot are hoping for a rate cut on the 19th. Do you think he's going to pull the trigger at the Bangko Sentral?
I think there is space for the room for one more cut next week. Markets expect the same, and hopefully there's more room for undercut. But I think what markets are thinking now is yes, there's space for one more cut this next week.
Got that, and it's coming real soon. Thank you so much, Raz, for opening the market week for us. Raz Mercado of China Bank Securities.